Hello again! It's been quite some time since I updated this playlist, so a new episode is warranted. In this video, I will talk about the famous internet bubble of the late 90s, which eventually led to a huge crash as many new companies went bankrupt. Let's see what the dot-com bubble can teach us. In 1991, the US economy experienced a recession, followed by gradual recovery and a veritable boom that lifted spirits. Economic growth was fueled by low oil prices, welfare reform, rapid technological changes, and a new market dedicated for young people who were eager to spend with no memories of hardship. Personal computers were no longer a luxury. The ratio of US families with a computer at home rose to 35%, and the rise of the internet meant that people had a new way to connect, learn about the world, and enjoy their free time. Some early adopters recognized that online marketplaces offered a great opportunity, as users would soon demand new services and products, so new entrants could compete with existing, well-known companies and even dominate this area. The World Wide Web was created in 1991. The first websites appeared back then, but the turning point arrived in 1994-95 when the first online credit card transaction took place, the first version of the Netscape browser appeared, and companies like Amazon.com and eBay were launched. E-commerce became a thing. By that time, 40 million people were online, and the market was rapidly expanding. Amazon's numbers illustrate this process well. Their revenue in 1997 grew tenfold. A year later, the company was valued at $14 billion. Everybody wanted in. Experienced businessmen and complete beginners were coming up with new ideas, some of which were sound, others less so. They all believed that the internet opened up a new world in which existing rules did not apply. Rapid expansion and sucking in more capital were the key, while profit would follow much later. Perhaps the best illustration of this short period is the history of Pets.com, which sold pet supplies to retail customers. Launched in 1998, it operated for 2 years, during which time most of its capital was spent on advertising and the creation of its shipping infrastructure. Their products were sold at great discounts to attract more customers. They spent way too much on ads. In 1999, their revenue barely surpassed $600,000, while they spent more than $11 million on ads, so their rapid expansion only hastened the company's demise, which came in late 2000. Without a sound business plan, Pets.com was a spending machine, wasting investor capital, never achieving anything significant. Another such company was Webvan, a grocery business that promised quick deliveries. Early investors poured millions into this venture. Hundreds of millions were raised through an initial public offering, IPO, even though their revenue did not even reach $400,000, compared to a net loss of over $50 million. In 3 years, they lost over $800 million. Then they filed for bankruptcy. Their concept of quick delivery would not be picked up again until 2020. WorldCom was a large telecommunications company that grew through mergers and acquisitions. They purchased MCI in 1998, then almost merged with Sprint a year later, which would have made them the largest player in the sector, at least in the US. Regulators opposed the move. It did not happen, but a much bigger problem was developing as the company was using fraudulent account methods to hide decreasing earnings. Costs were booked as capital expenditures. Revenues were inflated with bogus entries, eventually amounting to $3.8 billion before they filed for bankruptcy in 2002. They would emerge once again after reaching settlements with investors, but CEO Bernard Ebbers was found guilty of all charges after an official investigation. The company then signed a deal with Microsoft before being acquired by Verizon. In hindsight, these examples clearly showed that something was not right. Many of the newcomers, along with some of the well-known players, could not show actual profit. They were simply burning through the investors' money, and when their sources dried up, they collapsed. However, most people completely disregarded these facts. They believed that everything related to the internet and the .com domain was a treasure trove. During this period, besides venture capital firms, investment banks, and other businesses, retail investors started to play a more prominent role thanks to the internet and discount brokerages that offered lower commissions for their simpler services. Ordinary people were now able to invest in public companies trying to take advantage of the boom. Lowering the capital gains tax in the US encouraged more people to make speculative investments. They were happy to see seemingly never-ending rise in share prices, while investment banks profited from IPOs as new businesses were made public. In only 5 years, between 1995 and 2000, the Nasdaq Composite Index, that focuses on tech companies, rose by 400%. In 1999 alone, it almost doubled as investors sold slower-growing companies and poured all their money into new online businesses. The situation somewhat resembled the stock market craze of the late 1920s, when radio and the press fueled a speculation boom, sending stock prices much higher to an unsustainable level. Things were not different back then. This enormous rise had to be followed by a crash, as more and more people joined, often using borrowed money to buy anything that seemed to be rising rapidly in order to avoid being too late. This time, television, newspapers, and even major sports events contributed to the hype, resulting in a bubble that had to burst. Those who were still paying attention to traditional metrics could easily determine that stock prices were in extreme territory. Companies that could not show any profit and even increased their net loss kept going higher. But emotions once again got the better of most participants, as they were trying to get rich overnight. Some people quit their jobs and spent all their money on stocks. Others became paper millionaires by receiving employee stock options, but the rude awakening was not far off into the future. Very few, mostly experienced investors were able to sell and profit handsomely before the crash that occurred in March 2000. As more and more internet companies spent large amounts of money on TV ads, telecom companies expanded and promised huge advances in broadband and 3G access, high debt levels started to become a problem. Some executives did sell their shares before the crash. The exit strategy often consisted of taking the company public through an IPO and paying large sums to the founders, but investors got burned as many new companies struggled to find a niche, especially as the old brands established their online presence. To cool down the economy, the Federal Reserve started raising interest rates, which made it costlier to borrow money. Japan entered a recession once again. News articles warned about imminent bankruptcies. Stocks started to fall. Suddenly, the traditional metrics were back in play. More and more people realized that most internet companies were just burning through cash. Yahoo and eBay ended their merger talks. By the summer, spending on ads was greatly reduced. By November, when Pets.com went bankrupt, internet stocks had declined by 75%. The following year, the 9/11 attacks accelerated the drop. Then accounting scandals at Enron, WorldCom, and Adelphia led to more distrust in the system. The Nasdaq 100 eventually dropped 78% from its peak. Cisco alone lost 80% of its value. The downturn ended only in late 2002. In the end, another generation experienced a major crash, mainly due to unrealistic expectations and irrational exuberance. The subsequent recovery eventually led to the housing crisis and the Great Recession in 2008, but I have already talked about that in a previous video. Thank you for watching. See you next time.